turning out to be a dull day for the markets, but who better than Dr. Mark Mobius, the founder at Mobius Capital Partners, joining in to make sense of this madness that the equity markets are facing right now. Mark, such a pleasure having you on the show today and meeting you in person. Have to ask you first, what brings you to India?
Well, this conference, Morningstar conference, and also we are applying to put money into India because we have a new fund, so it's taking more time. So we hope to be able to accelerate that.
That's the kind of voice that you just want to hear right now, right? When everyone's questioning how much further the market is going to go, here's a guy who's willing to put money into India.
Yeah.
What gives you that confidence? Do you think that we're at the end of the pain when it comes to the India turmoil?
Well, we know there's a liquidity crisis.
Yeah.
We know that you've had this problem with the infrastructure company, and all of these issues are at play, and therefore the market has gone down maybe a little bit too far. The currency has gone down as well. So put this all together and it means there are bargains, there are good opportunities.
Mark, you've been making a call that one should actually not run away from bear markets. You should always go and commit when bear markets are on. So do you think the current route of selling in emerging markets across categories is more like a buying opportunity? And for those who will remember October 2018, as a period when they participated, they were benefited because of this?
Yes, I believe that we're at a stage where with interest rates going up in the US, their currencies in emerging markets have gone down dramatically. And of course, the markets themselves have gone down. So it's an opportunity to start buying. Now, I'm not saying we're at the absolute bottom. No one can predict whether it's going to be 20%, 30%. At the beginning of the year, I figured that emerging markets would go down by 20-odd%, and we're now about 22, 23% on the index. But the important thing to remember is that some companies are really bargains, tremendous opportunities. Some companies are not. So we now have to separate the men from the boys, so to speak. Companies that have weak balance sheets, that don't pay dividends, that have poor management, you want to stay away from. Companies that have strong balance sheets, pay dividends, and have a forward-looking management are going to be the winners. So you have to separate these two and not pay so much attention to the overall index.
Mark, emerging markets currently account for nearly 30 to 35% of the global market cap now.
Yes.
That's a sizable chunk now. It's no longer a $1 billion market or a $2 billion market. This 30% market cap now has corrected by 15 to 50%. So even though emerging markets are supposed to be high growth pockets, why are these markets correcting at a time when growth in general has been very precious?
It's mainly because of what's happened in the US. Because remember, the biggest pool of money globally is in the US. So what US investors do have a big impact. Of course, that impact is declining. As emerging markets grow, internally, you're getting big pockets of money investing in the local markets. India, for example, has a big domestic market. But nevertheless, people look to the US. They look at the US dollar. They trust the US dollar. So if interest rates are going up in the US, money flows in to the US dollar until interest rates in emerging countries catch up. You must remember, many of these, look at Europe. The euro is still paying almost 0% interest. So that has got to come up. Once that comes up, you'll see money flowing out of the US and into emerging markets. And by the way, you've already seen a reversal. We've seen money going into emerging markets recently as a result of these developments.
You know, I've been reading your views, Mark, and you believe that crude could go up all the way to 100. Now, that's like a double-edged sword, which is not working in favor of India. So, do you think if crude were to move up higher and get close to $100 per barrel, the whole India investment hypothesis changes then?
No, not really, because you must remember India's a big country. There are a lot of things going on where oil prices may not impact. For example, you've got huge coal resources. Agree. Problem with coal, it's polluting, but the reality is that when people want to produce fuel, then coal becomes a big factor. You've increased your solar, you've increased your wind. So yes, oil does have an impact, but it doesn't have to be disastrous. And it depends again on the industry. Some industries, the power consumption is not a big factor. So this would not, it's a very small part of their total costs. So
You
I
said
think this
earlier,
would look at.
sure. You said earlier that it's time now to separate the men from the boys. Where is it that you find those tactical opportunities when it comes to India? Because about a year back, it was financials which was the go-to place.
Yeah.
But look what's happening with financials right now. You've got this whole liquidity crisis, just about everyone's shunning even quality NBFCs. Is that the right pocket to hunt now? Because news and bad news is at its worst right now.
Right, there are going to be opportunities, and we see already some. Oddly enough, you would think the micro lending and the non-banking institutions would be dangerous, but in some areas there are opportunities in this sector. So we're looking at that very carefully.
Mark, in your previous avatar, you bought stocks like Reliance. You bought nearly 5-7% of the total equity capital of Sesa Goa. What is your view on commodities first and then commodity stocks at a time when we are staring at a trade war and a potential slowdown in China?
Well, I believe that commodities will continue to be a big factor. Just take the oil. Companies that are producing oil are going to do very well with this higher oil price. So I always tell people don't give up on commodities because commodities are required and in increasing quantities. You must remember the two most populated countries in the world, India and China, are going to use more and more commodities. It's going to be a big challenge because there are environmental problems with commodities, as you know. So commodities are not going to get cheaper, I don't think. They're going to get more expensive.
Mark, parallels have been drawn between 2008 and 2018, especially looking at the quantum of the sell-off. Now in 2008, when the world started folding up because of high leverage, money moved back into US dollar. That strengthened a bit more.
Yeah.
Money moved back from emerging market equities to US treasuries. If one works with an assumption that the US economy will start slowing down in 12 to 18 months after the sugar rush which they are enjoying because of tax cuts, how do you see the flow of money moving and changing?
I think you're going to see a flow out of the US increasing because as you reach these higher interest rates, they'll come to an end. I mean, there'll be a point where inflation is not coming up at the rate that they expected. See, this is one of the things, one of my big theses these days is that we're not in an inflationary environment globally. We're in a deflationary environment. Why? Because of technology. Technology is making things cheaper. So the CPI is based on a basket of goods which are changing. They're constantly changing the basket. But if you look at the basics, the food, they're not changing, they're going down. The World Health Organization, is looking at these prices and they're seeing a declining trend. So we are in that kind of environment, which I believe will hold up the rise of interest rates by central banks. But as the US central bank slows down its increases of interest rates, other banks around the world have to catch up because they haven't yet risen as much as they should. So you're going to see money flowing back to take advantage of these higher rates.
In that sense, would you say the Reserve Bank of India has been a little behind the curve because just about everyone on the street was expecting it's going to be a 50 basis points hike, look what crude has done. They chose to hold back.
In the case of India, I'm a little bit on the other side of the equation because I think India generally, the central bank has been, over the past I'm talking, has been too aggressive in raising rates. Okay. It would be better in the Indian environment to have lower rates because it would help the community at large and industry at large. So India is kind of a special case, I would say. Not necessary to raise rates in order to contain inflation. If you want to contain inflation, you've got to increase productivity. That means you've got to reduce the regulatory environment. Now, the single tax, the single excise tax, is a big, giant step in the right direction, because that has the impact of lowering inflation. Costs go down as a result of that, overall costs. So I think India is a special case.
When you think India, you think consumption, and consumption is just such a large basket, just about everything falls under the bracket. But I'm going to pick up autos per se. You've seen the market correction, auto stocks as well fall down. Each and one is an individual case, be it an Ayesha, be it a Tata Motors, or the one which is the 50% dominant market share, like a Maruti. Do you believe right now is the time to buy this decline in autos? Because whenever does the economy do recover a little bit, you will see auto stocks come back. Do you think right now is that time?
I think it's now time to look at companies that are advanced in electric automobiles, because that is the future, not only for the domestic market, but for exports. So the degree to which Tata Motors or any of these companies can develop an inexpensive electric vehicle will be very important going forward. So that's what I would focus on.
Okay.
And the technology is here. There's no reason why this cannot be done.
So Mark, if you've been an emerging market veteran, and no pun intended to your age. I mean, you genuinely have been investing into emerging markets for over 25 years now. Yeah. If you have to make a list which has got a headline title saying that Mark Mobius' favorite investable companies in India, how will that letter start and how will that letter end? So let me say that again. My favorite companies in India.
My favorite companies in India are those that have strong balance sheets, number one, that are focusing on ESG factors, number two, and are paying dividends.
What about valuations?
And the valuations, of course, we look at price earnings, price to book, but we found that these are not really good long-term indicators in itself. Of course, they're important, but what we're looking more at the growth. So I'm not so much interested in what the PE is today, but what it's going to be in 5 years.
Can you give me an example that what is looking expensive today may look cheap tomorrow because growth will come back?
For example, if you look at the banks here, if you really do the numbers, and I'm not talking about the published numbers, I mean digging really deep into it and where the non-performing loans are, you'll find that the price to book is very, very high, because a lot of the assets have been wiped out. But then if you look forward, the reforms that are taking place in the banks, they could look pretty good going forward. So that's an example of where, you have to take a 5-year view. Okay. These companies.
So let's take the next 5 years. EVs is one that you talked about. Where do you think the big disruption is going to come in when it comes to India? Economy, stock markets all put together.
The big disruption will be the internet, the impact of the internet and technology in general. The reason why I say that is that many of the traditional industries have not yet adopted a lot of the technology that is required. You take retail. They don't have inventory control based on the internet. They don't have an inventory of their customer base. All these factors have to come into play because they're going to be running into tremendous competition.
Mark, the India romance always has been centered around consumption. And when I say consumption, it's autos, it is staples, it is durables. Now, a classic investor would say, I like these businesses, but they are expensive. It's like saying I'm buying silver at the price of gold. Would you buy an HUL? Would you buy a Britannia? Would you buy a Nestle with a 5-year view?
This is a very good question because very often you'll find these tremendous names, brand names, that are selling at very high multiples. And again, I have to emphasize, what are they doing going forward? If they're going to stay where they are, I'm not interested. If they're making innovations in their product base, in the way they manage their businesses, then I'm interested. That means growth. So even though the valuation may appear to be high now, if you're seeing that growth going forward, PE levels will go down, price to book levels will go down, dividend yields will go up. That's what we're looking for,
So, Mark, in your investing career in India, at the peak, I've been told that Templeton had nearly $10 billion directly, indirectly invested in India. So which is one business you regret buying late and one business you regret selling early?
I would say that one business buying too late was probably the outsourcing businesses.
IT outsourcing.
Yeah.
Okay.
We didn't recognize the incredible potential there. Buying too early, some of the mining sector, we bought that a little bit too early. Because they had a lot of reforms to go through, and the whole environmental issues came in play. So we could have been waiting.
You know, a year from now, Mark, and the texture of the market would be a lot different than what we're at now. And we also have a very big political risk as well. This month, or rather this year itself, you've got 3 state elections, the run up to the big 2019 election. As someone who's sitting outside India, got a bird's eye view, what is it that you would want to see from the government in the next 1 year? Because the big fear in the market is that they're bound to turn a little populist, as any government would in the run up to an election.
I would say that if the current government could focus more strongly on the reforms that they announced when they were elected, that would go a long way towards strengthening their position. So in other words, implementing more forcefully these reforms. And a good example is what we're talking about of foreign investment, making it easier for investments to come in, particularly now, because the opportunity is tremendous. With the trade war between the US and China, India's got an incredible opportunity to garner some of this manufacturing.
But do you think there's a big political risk attached to the markets right now? What if the same government doesn't come to power? Is that going to be a big derogatory factor for the equity momentum?
I don't think so, because I think any government that gets in is going to be pushed to a reform. Because, as I say, with the internet now, with smartphones, everybody's aware of what's going on. The young generation are very impatient. They don't want to wait. They want action now. And any government is going to be forced to act.
Mark, you know, after a extremely successful career as an emerging market strategist with Franklin Templeton.
I know where this is heading.
No, you know, normally people retire at this age. You've started to take the plunge all over again. You're starting your fund, second innings. So what prompted you to start a second innings at this age?
Well, it was, you know, I recognized that there was a new era taking place, and it was time to get away from index investing and focus on the index. There was a time to look at the ESG factors. So looking at all of this, I said, well, maybe I better turn over a new leaf, you know, separate myself from what went before and start something new. And that's really the exciting thing. It's quite exciting. You know, when you hear the new ideas of analysts, it's just incredible. The analysts today are so much more advanced in technology. It's quite something.
It's quite exciting. So I have to ask you this. What's the mantra for your fitness? Because we've been seeing you for the last 15 years and not a single wrinkle. Your skin is as glowing. Tell our viewers.
You know, trust me, Ayesha never tells me this.
Well, I think the key is to exercise every day without fail. I get up in the morning, I get on the stationary bicycle, I read from my iPad, I read a book or something, and I go for a half an hour. And then in the evening, if I try to do some weight training, very important. But as you get older, your bones will get weak unless you put stress on them, you know? Yeah. So I think that's important. Now, my weakness is food. That's a problem.
Give me a high five on that.
Because I love sweets. So when I come to India, I go wild on Indian sweets. It's a real problem.
So Indian stocks or Indian sweets? What is the preferred choice right now?
Well, yeah.
What's sweeter?
They're both sweet.
All right, Mark, appreciate your time. Good luck with your second innings.
Thank
and
you
I
very
certainly
much.
hope to see much more of you going forward. And hopefully, you know, if all goes well, we'll see you soon in December.
Right. Thank you again.
Thank you so much.